I had this whole day planned. I was not going to sit down and make another gold video right now. And then I looked at the latest official buying numbers again and realized the market is still not taking the right lesson from them. Because if central banks keep buying gold, even at record prices, that changes the entire conversation. Not the hype conversation, the real one. The one about floors, sponsorship, and what kind of buyer is sitting underneath the market when everyone else is trying to game the next short term move. So here I am, because somebody needs to say the quiet part clearly. If central banks keep buying gold at record prices, the market may be dealing with a stronger structural bid than a lot of people still want to admit. I am recording this right now from Denver, and I want you to comment what day and date you are watching from, because I always love seeing how far these videos travel, and I want the timeline to be crystal clear because this story moves fast. And real quick, if you value this kind of straight analysis, do me a favor. Subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now, here's the claim making the rounds: gold is expensive. Therefore, central bank demand must eventually back off and the market should cool. And on the surface, that sounds sensible. Price goes up, demand goes down. Clean, efficient, obvious. But when you slow it down piece by piece, you realize central banks are not normal buyers. They are not buying gold the way a momentum trader buys a breakout. They are buying it like an institution, reinforcing the foundation of a building it expects to stand through storms. So let us start with what we can verify. Recent official data shows central bank buying remained very strong even as gold prices hit repeated highs. The total was lower than the wildest recent years, but still far above the average that used to define the old normal. Let me be blunt, that matters, because it tells you central banks may be somewhat price sensitive at the margin, but their strategic interest in gold is still intact. And that means every time the market assumes high prices will scare away official buyers, it may be underestimating how different this class of buyer really is. Here's the clean way to think about it: retail and fast money often trade the speedometer. And central banks are looking at the destination and the condition of the road. If they believe gold helps with crisis performance, diversification, and reserve resilience, then a higher price may slow them down a little without changing the mission. Same asset, different interpretation. To a speculator, expensive gold can look crowded. To a reserve manager, expensive gold can still look underowned relative to the risks in the system. Now, here is the skeptical alternative. Could central bank buying moderate if gold gets even more extended? Sure, that is plausible. We already know official buyers are not completely blind to valuation. They can pace purchases. They can wait for better windows. And I am going to say something that might annoy both sides. The bullish crowd is wrong if it thinks central banks will buy infinitely at any price with no regard for optics or portfolio balance. The bearish crowd is wrong if it thinks high prices automatically kill official demand. The reality is slower and more dangerous. Strategic buyers can remain in the market even while tactical buyers hesitate. And that combination can make pullbacks shallower and recoveries more durable than people expect. Here is what nobody wants to say. If central banks keep buying at high prices, they are telling you they think the reason to own gold is bigger than the latest chart. They are telling you the underlying reserve logic has not changed. Crisis resilience still matters. Diversification still matters. Store of value still matters. And when you put that next to survey data showing many central banks expect global gold holdings to keep rising, you start to see the bigger picture. This is not a cute side bid, it is part of the structure of the market. So, what happens if this continues? First, gold may develop a stronger floor than a lot of people are used to. Not a floor that means price cannot fall. That is not the claim. A correlation is not a contract. Gold can still correct hard. But a market with strategic official buyers sitting underneath it behaves differently from a market driven mainly by hot money and retail fear. Second, market psychology changes. If traders realize that dips keep meeting patient official demand, the whole rhythm of the market can shift. Third, the burden of proof changes. Instead of asking why gold is still elevated, people start asking what would make official buyers truly step away. That is a different question and a much harder one for bears to answer cleanly. Here's a question for you. Do you think central bank buying is now the real floor under gold? Or do you think macro traders still matter more? Drop that in the comments because I read them. Because I think the answer may be shifting right under people's noses. Now, here is a simple action plan. No drama. Step 1. Stop assuming expensive gold automatically means weak future demand. Ask who the buyers are. Step 2. Watch official data for persistence, not perfection. If buying remains broadly elevated even after strong price moves, that is a tell. Step 3. If you express this through miners, remember a stronger metal backdrop helps, but bad miners still destroy capital. And do not make the common mistake of turning a good gold thesis into a bad stock portfolio. Step 4. Keep it sane. Gold does not need leverage to be exciting, and a structurally sticky official bid can do more work over time than a flashy retail panic. Now let us map two plausible paths without pretending we can predict the exact candle. Path 1 is the strong floor path. Central banks keep buying at historically elevated levels, maybe not at the craziest pace, but enough to keep reinforcing the idea that gold belongs in reserves in a bigger way than before. In that world, corrections happen, but the market keeps finding sponsorship faster than people expect. Path 2 is the pause without break path. Official buying cools from the highest gear, but stays well above old norms. The market initially reads that as bearish, and then realizes the floor is still higher than it used to be. I am not predicting it. I am saying it is within the set of things this market is capable of doing. Now, here is the uncomfortable truth. Regular investors often try to outsmart price while institutions are trying to outlast instability. Those are very different games. And if central banks are playing the second game while retail and macro traders are still obsessing over the first one, then a lot of people are framing gold incorrectly. Institutions protect themselves through patience, size, and strategic allocation. Retail often shows up with excitement and no plan. That is why a defensive strategy matters. Because if this official bid keeps proving resilient, the people waiting for the perfect cheap entry may spend a very long time waiting while the structure underneath the market keeps getting stronger. 1. Decide your maximum allocation first. Write it down. If you are losing sleep, you are too big. 2. When something runs hard and you are up a lot, take some off. Not all some. If your position doubles, consider trimming half. Lock in the original bet. Let the rest run. 3. Do not use leverage or confuse narrative with mechanism or keep all of one thing in one place, depending on the topic. 4. The best time to buy is not always when you are most excited. The best time to buy is when you can still breathe. So here's what we covered. If central banks keep buying gold at record prices, well, that tells you the official sector case for gold is stronger than a lot of traders still appreciate. It suggests a market with a more durable structural bid, not because price can never fall, but because the reasons for ownership are bigger than the latest chart. And if that continues, gold may behave like a market with deeper sponsorship and a firmer floor than many investors are used to. The mechanism is doing something that most people do not see or will not understand until it is too late. Stay alert, stay sized appropriately, and do not let simple price logic talk you out of understanding what kind of buyer is really sitting under this market. Now, here are my questions for you. If central banks keep buying at high prices, do you think that changes your long-term gold allocation? And do you see gold now as mainly a trade or as a market with structural sponsorship from official money? Drop your answer below and remember to include what day and date you are watching from. If you got value out of this, subscribe and comment FinTalk OG, so I know you want to follow up on central bank demand, official reserve trends, or how to position if gold keeps acting like it has a stronger floor underneath it. All right, take care of yourself, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.